Hello, and welcome to Boston Common Asset Management's quarterly update webinar for the first quarter of 2021, discussing our U.S. large cap value and global impact equity strategies. I'm Kristen Jenko, Head of Client Service at Boston Common, and I'll be your host today. First, a very warm welcome and a thank you to our clients and partners who have taken the time to join us today. You all make our work possible, and we're very grateful to work on your behalf. Activating your capital for financial return and positive social and environmental change. So thank you again for taking the time. It's my pleasure to introduce our speakers today, Boston Common CEO, Allison McDonald, Geeta Iyer, founder and president of Boston Common, who's here with us today in her capacity as lead portfolio manager for the US large cap value strategy, and Corney Beemans, portfolio manager for our global impact equity strategy. Over the next 30 to 45 minutes, we'll touch on several topics. Allie will provide a brief update on the firm and share some of the exciting things that have been happening here at Boston Common in the first quarter. Geeta will walk us through the value portfolio, discussing performance drivers, positioning, and portfolio strategy, highlighting, of course, our approach to seeking companies that are providing solutions to society's challenges. And similarly, Corney will provide an update on the global impact strategy. Along the way, I'll be sharing a few highlights of our shareowner engagement work and firm milestones for the quarter, and then we'll finish up with a brief Q&A session. We'll be addressing our questions throughout the discussion, and you can submit them by clicking on the Q&A at the bottom of your screen. We'll answer as many questions as we can during our allotted time, either live or through the Q&A chat. So I'm going to get started right away and turn over the floor to Allie to share some of the exciting updates that have happened in the first quarter at Boston Common.
Great. And thank you so much, Kristen. And I'd like to echo Kristen's comments and thank everyone for their ongoing partnership and confidence in Boston Common that allows us to do what we do every day. And speaking of doing what we do every day, we are all still doing that remotely from home. Our plan is to phase back into the office slowly this summer and more significantly in the fall. But what we've learned, I think, as many of you have learned in your own business, is that we've adjusted well to remote work, and we recognize how lucky we are that we're able to continue to work efficiently and effectively on your behalf during this period. In fact, working effectively, we've had one of the best years, as you know, in 2020, we had one of the best years in terms of performance, new business, and AUM growth in our company's history. And we just finished our best quarter by far in terms of new business and AUM growth. What I'd like to do is cover a few things today. First, I will talk about that AUM and the AUM mentioned here on the slide. And then I'll discuss the transaction that we completed this quarter with our new equity partner, AMG. And lastly, I'll talk a little bit about how we're positioning our business to scale for the great growth that we are experiencing. So as you can see on the slide, our current AUM sits today at $5.3 billion in assets under management. Just to provide some context for those that may not be following our AUM as closely as we are, we were $2.8 billion in January of 2020 and $3.9 billion this January in 2021. Again, as you heard, 2020 was record-breaking year on many fronts. And then we just added $1.2 billion in assets in the first quarter of this year. But let me provide some context. The increase in 2020 and over the last 15 months was due to really strong performance, strong new business and some large mandates, great market growth, and very little client attrition. We also have been more recognized as of late for our minority or emerging manager status due to a general increase, I think, in investors and allocators looking for more diverse managers. Specifically, I should point out, though, that this $1.2 billion or so in assets that we added in Q1 2021, of that, $900 million or so is a sub-advisory mandate that we just received from our new partner, AMG. I make note of this in that this fund that we took over was managed as a US all-cap growth style, and we're changing the mandate to our global impact strategy. So we expect perhaps about half of these assets could leave. So please don't be alarmed if next quarter we're talking about a slight decline in our AUM. But even without the $900 million, we still had a very strong first quarter 2021, and I think one of the strongest in the company's history. Needless to say, we are very pleased in the growth in assets and the opportunity that you've all been bringing us. So speaking of AMG, I think it's important for everyone to understand why we did this deal and what it means to Boston Common in the long term. First, many of you are aware that other small pioneers in the ESG business and other boutiques have been purchased or combined with other asset managers or other publicly traded companies in the last 5 years. And we've certainly had our fair share of interest in our business. In fact, at the beginning of 2020, we had a company seriously seek to buy 100% of our company. And as a management team and board, we did due diligence and some soul searching. And we decided that we didn't feel as Boston Common that we would be able to do what we do and be our authentic selves and not have conflict if we were to be purchased by a publicly traded company that has other businesses besides ESG and impact investing. And so we made the decision that we were going to do what we needed to do to stay independent. Post that, we started conversations with AMG, and we were very impressed by the management and the team members from AMG, and we were impressed by their ability or their willingness to be flexible in building a partnership with us. We talked about being Boston Common and staying authentic and true to ourselves and staying independent. And we found out from AMG and we found out from AMG affiliates that this is core to their culture, that they are intentionally work with boutiques and let the management run the company and leave them independent to do what they need to do. Yet they provide consultation, advisory, and a sounding board on a regular basis. So we were excited to hear about this flexibility from AMG. As many of you know, Rosemont Partners owned 20% of Boston Common, and we were 80% employee owned. AMG was willing to put together an opportunity for us to buy back 5% of our stock and to take out Rosemont Partners. Rosemont had us in a private equity fund that was coming due in 2023. And at that point, there would have been a not so insignificant payment that Boston Common would have had to make. And so by taking out Rosemont Partners and being permanent equity, AMG took that, opportunity for us to have to pay Rosemont off the table. So after doing the deal with AMG, we end up at Boston Common is 85% employee owned and 54% women owned. And AMG owns now 15%. So we are not only excited to have this great partner who is a trusted advisor and consultant to us, but AMG also provides us opportunities for global distribution. And this was something that was in our growth plan to hire and create more of a distribution opportunity for Boston Common. And by doing this deal with AMG, we got cost-effective, scalable way of offering distribution. And then last but not least, they offered us an opportunity for sub-advisory. And so the aforementioned 900 million plus Global Impact Strategy Mutual Fund was also part of that deal. So what doesn't usually happen in three-way deals in financial services is that all three partners or all three parties walked away happy. Rosemont got fairly paid for its investment in Boston Common. AMG had an affiliate that fits with their new strategic plan and outlook. And Boston Common can continue to manage our business in the same client-centric, people and planet-centric and authentic way we always have. So this, I think, is very good news for Boston Common in the long term. And then the last thing I wanted to talk about before I go to the performance slide is how we're thinking about this growth and how we're preparing the firm for this increase in assets and activity. And to be clear, this isn't a reflexive or reactive stance to the significant increase in business. Our strategic priorities in 2020 started with the concept of scaling and strategic growth and creating efficiencies and capacity for this growth. The most important thing that we keep in focus is that we are able to continue to deliver a high level of customized client service for our clients and deliver the boutique experience Boston Common is known for. We do not want to give up what truly makes us unique and authentic for the sake of new AUM. And we want to make sure we're servicing the business in the most effective way for you all, maybe even improve some aspects of this. So not only are we working on creating efficiencies, we are bringing on new technology. We're bringing on Salesforce and other tech platforms to aid us in content management, trading, and reporting. And of course, we're hiring more people in key roles at the firm. On the new hire front, and you can see it on our next slide, we've added a great analyst to our operations team, Kathy Young, who comes to us from State Street. And as you can see on this integrated ESG investment team slide, we've promoted Jonathan Starr, who has been with the firm for 3 years. We've promoted him to research associate from our client service department, where he is a standout with data and reporting, and he's currently completing his CFA. And then lastly, we just announced Leah Torino, who worked as an ESG research analyst at Boston Common 5 years ago and has been spending the last several years at UBS. We brought her back, we brought her home in a newly created internal and client-facing role as the head of ESG integration. We continue to post new roles, and we appreciate any candidate leads that you have provided for us and offer you to continue to do so. So my last responsibility for today's webinar is to discuss the performance slide. And there it is. And I told the team I only wanted to discuss the performance slide when this is what the performance looks like. I'm just kidding. But something of note is that our performance, as you know, was very, very strong across the board, significant outperformance in 2020 across the board. And of note in Q1 2021 is that we gave some of that outperformance back. But as you all know, we are long-term investors, active investors with focusing on a 3 to 5 year investment time horizon. And you'll hear that from some of my colleagues today. And then lastly, before I hand it back to Kristen, I wanted to mention something that based on feedback from a lot of our consultants and our clients and the increased interest in our emerging markets strategy, we are going to be launching at the end of May an emerging markets mutual fund. So that is on the things to come in this quarter. So I look forward to taking any questions you may have at the end of the webinar, and I thank you again for your continued support of Boston Common.
Thanks so much, Ali. Now I'd like to turn it over to Geeta for a deeper look at the US large cap value strategy and some of the drivers of performance for the quarter.
Thank you, Kristen. Thank you, Ali. It's my pleasure to speak to you about the quarter just passed and about the value strategy as a whole. It's a long-standing strategy for us, benchmarked against the Russell 1000 value, about 50 to 70 names. Just quickly to recap, we've seen some asset growth and strong returns in the last year. We have a strong portfolio management team, experienced team working together for a long time. We draw on the work of our really spectacular ESG team, our in-house engagement and research team. Our annualized returns versus the benchmark are at the bottom, and on the left-hand side, you can see our goals, which we've kind of met in the bar chart. So we aim to outperform the Russell 1000 value benchmark over the long term, gross of fees. I'm going to skip to say that typically we achieve that path by preserving capital in down markets. You saw some of that in 2020. And again, actually this January when the markets declined. So there's an aspect of financial and ESG quality and portfolio construction, which create that opportunity for us. And the most important thing that we spend a lot of time on is to seek sustainable names that are misvalued and have catalysts for re-rating from fundamental, structural, and ESG sources. This is what I'm going to talk a little more about before diving into this quarter's performance report. So if you could go to the next slide. I'm going to talk first to the right-hand side of this page. There are 5 strong drivers of our work, and they are drawn from our distinctive approach to ESG and financial analysis, our deep knowledge of the space, our experience in this space, our ability to recognize patterns in this space. So starting off with the diagram on the right-hand side, We find solutions revenues. We want to invest in companies that are addressing the world's biggest environmental and social challenges. We think they will see more opportunity for their products and they will build lasting competitive advantage. Our focus is in areas of climate change and earth renewal, inclusion and empowerment, health and community well-being, not at all surprising given our desire to work in this space. Second, we look for ESG leaders. They are companies that have better practices, better ESG. They may have a more diverse workforce. They may treat their, we hope they also treat their people as assets rather than costs. They have ethical practices. They improve energy productivity and efficiency. These are all able to unlock value, and their potential is sometimes not reflected in the valuation in the marketplace. Third, we find companies with ESG momentum. And these are companies who are improvers that have improvements that they are making. They're not solutions leaders, nor are they ESG leaders. They are making progress towards sustainability, improving their products and their practices and the way they make things. These opportunities are dynamic. They're not fully recognized by the data vendors. They're not yet reflected in the valuation typically. Our proprietary ESG work, our experienced team, our deeply integrated approach with which we can identify ESG momentum, and then our engagement work, which is proactive and targeted and effective, can catalyze, support, and strengthen the company's progress, its ESG momentum, as it were. So that's that little, so this graph is, graphic is intended to show you that there are these three buckets within the ESG thinking that we bring to the table. Two things I want to point out is that the bottom left, all these companies meet and exceed our ESG guidelines. We are not looking to compromise our ESG standards, our high compromise ESG standards in this process. And then that aspirational arrow, this kind of a curvy one going to the top right, says that we are looking to improve products and service, policy and process, what companies make, how they make it, how they run their companies through our engagement work, moving them up at all levels. Finally, of course, we are value managers. And so we have sector appropriate valuation metrics. We have a disciplined and pretty standard and traditional strong understanding of fundamentals and a disciplined process. And fifth, I believe, in addition to stock selection, which typically adds most of the value in our performance or relative performance, we are experienced portfolio managers. We have seen many market environments. Portfolio construction and portfolio management adds value in a value-oriented strategy, in a US value strategy. So go to the top left, the left bar of this page, highlighting some current portfolio holdings with this in mind. So within the solutions leaders, which are over 50% of their revenues are derived from these types of products, which means they're primarily engaged in solutions activity. There are many companies, including KB Home, a green housing company, or Steel Dynamics, which makes steel from scrap steel. So the raw material is recycled steel. And their process is the electric arc furnace, which is much less energy intensive than the blast furnace, or spin-off situations like TopBuild and Carrier. These allow us to quickly capitalize on the unlocking of the sustainable revenue growth, the solutions-oriented prospects of these companies, which gets liberated and is able to be expressed as the spin-off becomes an independent actor. Again, our long history and familiarity with these names means that we recognize it quickly when it's being spun off. TopBuild makes insulation materials, and Carrier makes energy efficient air conditioners. Moving to sector relative ESG leaders, these might be due to improving industry fundamentals that we find an opportunity to buy them, or a company may be experiencing business challenges, which are temporary, and we are able to see a path to that re-rating becoming possible. ESG momentum companies whose improvements are not yet reflected in the valuation. Morgan Stanley declared its commitment to sustainability right after the financial crisis. They've continued to make strides in this space. About 75% of their assets under management today have sustainability criteria. They invested in Calvert, a leading player in the ESG space. The company became a signatory of PCAF, Principles for Carbon Accounting Financials, and or a company which is repositioning in the last bullet there, Aptiv, which used to be an auto parts company, Delphi, becoming an electric vehicle supply chain player, or Iron Mountain, a document storage company, becoming a data electronic storage company, where again, the footprint is diminished by this transition. These are some examples and our approach. Let me switch to talking about the quarter that just was and what a quarter it was. If you can switch to the following slide. It's a busy page, but there's a lot to tell you quickly. US value benchmark, Russell 1000 value, returned 11.26 this quarter versus the S&P 500 of 6.2. So another quarter like the fourth quarter of last year, where value successfully outperformed significantly the core and growth strategies. It was a very cyclically driven quarter. All sectors were up, but there was dispersion. Energy rose phenomenally, 31.5% this quarter. And that's 3 times the benchmark and about 5 times the S&P, or 6 times the S&P. Financials rose 17.5%, and consumer discretionary 14.5%. And on the flip side, many of the defensive sectors rose but did not rise as much as the market benchmark did. Our portfolio, you can see in that gray bar going across the page called total. Model portfolio return was 11.2% versus the benchmark of 11.26%. So keeping up in this very cyclical high performance by energy quarter. We are really very, very happy about the performance of our stock selection. You can see that not owning energy sector cost us 89 basis points. That's the far right column of numbers. It's also in the graphic below. Stock selection made up most of the gap. Semiconductor names like Applied Materials, steel makers like Steel Dynamics that I just spoke about, housing players like KB Home and Mohawk, banks and financial companies, Citibank, Fifth Third, PNC Bank, US Bank, Ameriprise, which is a financial services company, agriculture and construction company, Deere, all of them contributed strongly. And so it was really a broad spectrum of stock selection that helped. And predictably, some of the leaders in the lockdown era, like UPS, Procter & Gamble, Colgate, Merck, Cerner, these all underperformed the market, gave back. And then there were some big gainers from the from last year, like First Solar and Hannon Armstrong, that also gave back some of their gains from last year. Moving to the next page, this is the economic outlook and strategy page. Here I want to highlight that the economy actually shrank 3.5% in 2020. This is the sharpest contraction since the 1940s, bigger than the Great Financial Crisis and all prior recessions. And so it's important to keep that in mind as to how sharp and deep it was, how quick and deep it was. Monetary support, fiscal stimulus, vaccines, pent-up demand, all of which are helping to contribute to the expectation that we will have an unfolding economic recovery, which is also very strong. So in the fourth quarter, the economy recovered by 4%. IMF estimates that this year will be a 6.4% growth year, and that 2022 will be a plus 3.5% growth year for the United States, which means that we will be in a trend growth rate that is higher than the pre-pandemic trend, which is more like 2% growth. This is coming from several sources, and we'll talk a little bit about that. But essentially, you can see that the Federal Reserve has remained accommodative. They've been steadfast, clear, and consistent in their expectation that they will be supportive until a reliable inflation rate over 2% is reached and a full employment of 4% is reached. So we don't expect any surprises on rate increases or indeed on tapering in the near future. Despite improvements, 8.5 million people remain unemployed. The Fed's gaze is on preventing. Their goal is to prevent the scarring and the long-term trends that are challenging for the US overall. Mechanization, artificial intelligence, skill gaps in the population. These are all challenges that they have their eye on. The recovery path is still concerning, though the markets are discounting a smooth reopening. Supply chain disruptions and staffing shortages could slow down the economic acceleration. They could also bring temporary inflation. We are seeing these news items dominate the news flow these days. We also expect that habits have changed and the reopening will not be a return to the past. We've written and talked about this a lot in the past. Indeed, the K-shaped recovery is still in place. And so there is a lot that the economy needs to overcome. And hence the additional growth drivers like the Biden administration American Jobs Plan is an encouraging development of spending $2.26 trillion in infrastructure and capacity building over 8 years to be financed by tax increases over 15 years, tax increases and savings over 15 years. So if whether or not this passes in the way that it's been proposed, we think that this will enable a more sustained trajectory of growth and that we will not see runaway inflation, but rather some spikes, which and the levels of inflation are such that the Fed has tools in its arsenal, so to speak, to take care of those. Portfolio rebalancing has become important for us. We are more modest. We are not after this extremely strong, economically sensitive quarter. We are more in a barbell with some defensive positioning as well. So our focus is very much on stock selection. We think there will be a lot more dispersion, that winners and losers will be identifiable and earnings trajectory rather than overall tide will drive returns. So moving to the next page, we made some changes in the portfolio. We added a bit to beneficiaries of economic recovery like Steel Dynamics or TJ Maxx or Fidelity National, which is a payment processing player. We are also adding a little bit in the risk return proposition being improved by declines in the last quarter, like Cerner, which is medical records automation player, or Kimberly-Clark in the hygiene products space. We have taken some profits by trimming below on names that have had strong performance, and we took some profits from the semiconductor overweight that has helped us so much in this past quarter. On the right-hand side, we identify names that we have added. We have looked to add to sustainable investment spending, a long-standing theme of ours. We think this recovery will enable that quite a bit. So Magna International is a vendor in the auto parts supply chain space. They are the third largest auto supplier. They are a vendor to a lot of the large OEMs. And so we're not picking winners among which car maker will win, but rather we like the good stuff that's going on at Magna with serving the EV market and the declining, their emphasis on reducing vehicle weight, which is very important in reducing the energy use for vehicle, for driving. Weight is a big driver of that. And then also assisting drivers electronically. We purchased Sprouts Farmers Market, which has now improved its execution and refocusing on smaller stores and on their loyal customers. They are within the health and wellness space. We bought some exposure to American Express and Fifth Third as our economic recovery plays from the rebound in travel and loan activity. Midwest-based Fifth Third Bank is one that we've owned in the past. American Express is an ESG leader we've owned in the past. Healthcare-wise, we purchased Regeneron, which had declined after the headline news around the COVID cure. And then we thought that their strong R&D profile was undervalued and misvalued within the markets. And so we had a chance to pick it up at an attractive valuation. And then we added Valmont, which is a player in the infrastructure space, utility spending on growing grid compatibility for renewables integration or water conservation, where they are a maker of efficient irrigation products. And we closed some positions below where we took profits, or where we traded some of the names for the better names above, or where we thought the ESG outlook was declining. Moving to the next page, you can see the portfolio's positioning at quarter end. We are overweight some of the cyclical sectors like consumer discretionary. We've been that way for a while. Financials, we are overweight slightly. Industrials, and also technology, but importantly also REITs, which we think is a catch-all for a number of sector exposures that are under the structure of a REIT, and gives us an opportunity to pick up some winners there. We have no exposure to energy. We are underweight communication and utilities, some of the bond proxy sectors. You can see our carbon emissions profile on the top right. As you might expect, we have a much smaller carbon footprint than the Russell 1000 value, both on scope 1 and 2, but also on scope 3 emissions. And at the bottom right-hand, you can see that we have a very classic value profile. We have typically about an 80% active share and 3 to 4% tracking error, and a classic value profile, even lower valuations than some of the Russell 1000 value metrics on the right, bottom right of the page. This is everything I had, and I'm going to end here and hand over to Kristen.
Thank you so much, Geeta. Before we turn it over to Corné to give an update on the global impact equity strategy, I'll share a few notable updates on our share owner engagement work that apply to both strategies, as well as some firm level milestones. This quarter, we joined the Net Zero Asset Managers Initiative, and we've committed to net zero portfolio emissions and a 1.5 degree scenario alignment by 2050. Setting net zero goals by 2050 is also a key engagement ask, particularly for the financial sector under our Banking on a Low Carbon Future initiative. And this is also an example of how we walk our talk, as we say, expecting the same standards of ourselves as we engage companies to improve on their ESG profiles. We were able to withdraw our shareholder proposal with Citigroup after it made such a net zero commitment this quarter, and also joined the Platform for Carbon Accounting Financials, something Geeta mentioned in her comments. Boston Common is an active member of PCAF, helping to set standards for the industry. We have an ongoing focus on COVID-19 and systemic racism at Boston Common. And we continue to address the impacts of health inequities in our engagements, particularly with pharma companies. This quarter, we withdrew our shareholder proposal with Regeneron, as Geeta mentioned, a recent purchase there, after the company increased its disclosure around access strategies for COVID therapies. In the aftermath of the January 6th Capitol riot, we asked several US portfolio holdings to stop political donations to representatives who opposed the election results, and also to close their corporate political action committees. And as a result, UPS has stopped all PAC contributions. We also joined the Investor Alliance on Human Rights in leading outreach to apparel and technology companies on addressing human rights abuses in the Xinjiang Uyghur Autonomous Region. Portfolio holding TJX confirmed that it no longer has business relationships in the region. And following our engagement with home improvement retailer Lowe's, the company adopted a chemical safety policy and made time-bound commitments to phase out harmful substances in pesticide products, carpets, and rugs. And the company is also continuing this momentum by reducing products with glyphosate from their shelves and offering organic alternatives. And now I'm going to turn it over to Corné for our global impact portfolio review. And Corné, can you share a deeper look at some of the drivers of performance for the quarter?
Thank you, Kristen, and good afternoon, everyone. Our global impact strategy really aims at making investments that deliver a positive and competitive financial return and a benefit to society at the same time. Think of the strategy as the best of breed of investment impact companies globally, of a dedicated ESG investment boutique. We remain very excited about this strategy and believe it is a unique product at the right time. In this pandemic, most of the fiscal stimulus and recovery plans in Europe and Japan have one thing in common. It is strongly focused on sustainability, and green seems to be the color of recovery. In the past quarter, we've actually seen several large companies coming out and sharpening their climate action goals. These plans are large. The company climate commitments mean a radical change, not only for the economy, but also for corporate business models. And we believe that this fund, this strategy, is optimally focused to benefit from such initiatives in the years to come. Let's turn to the next page, please. So, after a very strong performance in 2020, the specific market conditions in the first 3 months of this year were challenging from a relative performance perspective. The global impact strategy returned close to 2% for the quarter versus 4.6% for the MSCI All Country Benchmark. All of the underperformance was actually concentrated in the month of February, as the other 2 months were flat to positive. The faster rising world index in Q1 was strongly driven by cyclical exposures and reopened beneficiary stocks. A broad swath of commodity prices rose across the board, and long-term interest rates increased and impacted higher multiple stocks, especially those that have had strong price momentum. They reversed course. Depressed cyclical value stocks, on the other hand, especially in the energy and financial sector, performed much better. The market action pressured some of our eco-efficiency and renewable energy solution holdings, which predominantly are to be found in the industrial and technology sector, as you can see on this slide. Specifically, global market leader in global glass panels, Chengxi Solar, declined sharply on concerns that glass solar prices may peak. Another Chinese firm, BYD, also declined sharply, while machine vision provider Keyence in Japan and electronic payments firms by PagSeguro in Brazil also gave up some of its earlier strong gains. Bucking this trend was a recent purchase, Bodyart, a Norwegian chemical company in the materials sector that specializes in alternatives for petrochemical products. Considering the names that I just mentioned, it is no surprise that regionally, continental Europe and emerging markets were the primary detractors. The US contributed positively to relative performance, helped by semiconductor equipment manufacturer Applied Materials and efficient engine producer Cummins. We can see that on page 17, please. The US consumer discretionary sector benefited strongly from solid performance from some of the sustainable housing plays, such as home builder KB Home, flooring tile maker Mohawk Industries, and insulation specialist TopBuild. For the past 12 months, the global impact strategy rose 63.7% versus 54.6% for the benchmark. We believe it demonstrates that impact exposure can be combined with very high sustainability characteristics to drive attractive returns. After making a number of changes in the fourth quarter, the amount of purchases and sales was substantially lower in Q1. We did trim a number of high multiple stocks in the beginning of the quarter, which helped, but did not prove to be sufficient. We sold Keyence following a long performance of outperformance, as we believed there was hardly any further re-rating potential left for this eco-efficient yet expensive stock. We used the proceeds to buy US-based Sprouts Farmers Market. We see this grocery retail chain as a solution name in the healthier product impact category, as it offers mostly fresh and natural foods, combining health with value to support consumer demand for healthier eating and lifestyles. And the recent weakness in consumer staples actually provided a long-awaited entry opportunity. Let's move to page 18. So over the years, we at Boston Common have developed a proprietary list of global impactful companies. We define such companies as those that have products or services that provide solutions and generate positive impact regarding the many environmental and social challenges in today's world. In this global impact strategy, we aim to invest in those solution leaders, which we define as those having over 50% of their revenues aligned to one of our 9 impact categories. These 9 impact teams are highlighted in the circle. In addition, we identify companies that we believe have already very substantial impact revenues and will over time evolve into product solution leaders. Alongside our investment, we create additional impact by actively engaging our portfolio holdings on issues such as diversity and governance. The next slide actually shows you the 9 global impact investment teams as well. And we also list some of the companies that we are currently invested in. One of such companies is actually Shimano Incorporated in Japan. It's a leading provider of electric bike components. Electric bikes allow people of nearly all ages to enjoy the outdoors and stay healthy by staying in motion. In a certain ways, bike parts may actually be compared to semiconductors. Just like semis, bike parts across the world are sold out due to very strong demand across the world. So the Japanese exports of bicycle components were actually up 35% year over year in February, which is a good barometer of Shimano sales. We also expect an extending restocking period for a lengthy period of time, and we believe that can support Shimano. So again, combining impact revenues with very attractive fundamental revenue outlooks. On the next page, we show you some of our future solution companies. And I want to highlight one example, going to look at DSM. We believe that DSM, based in the Netherlands, has a strong and highly desirable product portfolio that extends from nutritional ingredients to food fortification. What makes DSM products really desirable is how they address sustainable market trends, such as improved health and wellness, sugar reduction, and food chain efficiency. We also highly value DSM materials business that create new opportunities for advancement in technology that support the circular economy. Also, bear in mind that DSM is developing what they call bovine feed adhesives that reduce the methane emissions in cattle by as much as 30%. Turning to the next page, we show you a diagram of the strategy's overall portfolio exposure and how much is invested in each and every team. As you can see, 75% of the portfolio is invested in highly sustainable companies that derive more than 50% of their total revenues from solution activities. The diagram also shows our overall portfolio exposure is aligned, well aligned, with the United Nations Sustainable Development Goals. On page 22, we show you the portfolio characteristics of this strategy, including the top 10 holdings and also showing the diversification among the impact investment teams. In contrast to many other global impact strategies that are often small cap in nature, this strategy has a sweet spot in the market capitalization of a $10 to $50 billion range. It's an all cap strategy. The portfolio characteristics are actually not very different compared to the world benchmark, but they do provide, in our opinion, substantially higher expected revenue growth and also a lower variability in earnings. Importantly, this strategy has an active share of 97% with a tracking error currently around 4.3%. On page 23, we show you that in terms of portfolio positioning, the strategy is currently overweight the industrial and material sector, has no exposure in the energy or communication services sector, and is underweight the staples and financial sector. From a regional perspective, the strategy remains underweight North America and overweight continental Europe, the UK, and Japan. From a thematic perspective, the largest impact investment team remains eco-efficiency and recycling. This quarter, we also show you a spotlight focusing on Carrier. That's on the next page. Carrier is a global provider of heating, ventilation, and air conditioning, HVAC, but also of refrigerating and security solutions. At the moment, and also for the next couple of years, we expect new construction to remain strong, and that drives very strong demand for HVAC. Also note that HVAC system needs to be replaced every 12 to 15 years anyway. But what makes it very interesting right now is that there is a new regulation about efficiency coming up in 2023, and that will likely accelerate the replacement cycle. Also, the company's cold chain monitoring solutions are used to enable the safe and reliable transport of food and beverages, perishable cargo, but also of medical supplies. Think of the deep freeze transportation of the COVID-19 vaccines that hopefully many of you have already received. With that, I turn it back to Kristen.
Thank you, Corné. I think we can all turn our video back on at this stage and bring the presentation down to open it up for a short Q&A. And maybe we can give our listeners back a few moments of their day and wrap up a little early as well. So we have just a few questions. Corné, let's start with you. You talked about the Green Deal in Europe. So what about other countries? Have we seen more of such initiatives in other countries?
Well, yes, that's a good question, Kristen. We've actually seen more of such initiatives. The European Union is certainly not the only one. Last month, China announced their new 5-year plan, in which it aims to reduce the energy intensity by up to 20%. So the focus of China has really shifted from cleaning up towards emission reduction and decarbonization. Bear also in mind that China is actually the world's foremost emitter, as it produces 30% of global emissions of CO2. Also in South Korea, we've seen the introduction of the Korean New Deal. Korea is the 7th largest carbon polluter and has set a net zero emission standard for 2050. In Japan, last year, Prime Minister Suga stated that also Japan aims to cut greenhouse gases by 2050 and become a carbon neutral society. The United Kingdom is actually on the forefront. They announced a 10-point plan last year. Boris Johnson, Prime Minister, wants to introduce a ban on new petrol cars from 2030 onwards. And actually yesterday, the Financial Times leaked that they are planning to even strengthen their emission targets. And then also, last but not least, the US has rejoined the Paris Climate in January. And following the UK, we may expect that also the US is thinking about a similar target as well.
Great. Thank you, Corné. One question for you, Geeta. So you've described finding companies with ESG momentum. How does that differentiate you from a traditional value manager?
Remember that my goal is to find companies that are misvalued, that are sustainable companies, but look for companies which have a catalyst for re-rating. And the re-rating can come from fundamental financial factors or from industry structural factors or from ESG improvements. So because we view ESG issues as truly integrated with financial thinking and identifying it and acting on it as such, this isn't anything new for us as Boston Common. We are able to take advantage of this pattern recognition that we've developed over time and act on it in the portfolio. I believe conventional value orientation may have managers who look for catalysts, but they don't necessarily include the ESG side into it. And that's why, as I mentioned, this is something that we can discern and act upon even before they are captured in the rating agencies' ratings of the company or upgrades of the company, and that we have long done this. It has always been a part of our work to have 2 independent, empowered teams covering ESG and financial research, research-driven conviction is the foundation of our stock selection and our 50 to 70 holdings that we hold in the portfolio. When we get corroborating information from these two independent vantage points, it emboldens the portfolio manager to act. Or if we get a contradictory indication from one of the two, then we may hang back and not be so, leaning into an idea or a position. So ESG momentum and improvements and our understanding of how that is faring has always played a role with, if it's deteriorating ESG or improving ESG. I do want to point out that we're not using this to lower our ESG standards, our sustainability requirements, nor are we using it to lower the product-oriented viewpoint that we may have. We're not looking to include companies with primarily revenues from undesirable or not quality or not safe products that may show improvements. We're really looking for companies that meet all our high standards and then demonstrate this. Because it is in the realm of judgment, because it is in the realm of having uniquely identifiable information, and we are looking for our own proprietary metrics of improvement, I believe this gives us a real edge. This gives us a real edge over value managers, partly because the whole space of value is viewed as being completely incompatible or the very opposite of sustainability or ESG guidelines. In fact, most people would say ESG value, that's an oxymoron. How do you put these two words together? Because most companies reach the realm of value by violations on the ESG side or by having product or class action lawsuits that have dragged them down into that space. And so from our point of view, this is really very well suited to the contrarian mindset that we bring to using judgment to manage portfolios.
Thank you, Geeta. Well, it looks like we have no further questions at this time. So on behalf of Geeta, Ali, and Pranay, and all of us here at Boston Common, I'd like to thank you all for taking the time to join us today. As always, we greatly value the work you entrust us to do on your behalf. And we invite you to reach out with any questions you might have following this webinar. We're wishing you all good health and continued safety, and we look forward to speaking with you and hopefully having the opportunity to see you all again in person very soon. Thank you.